On April 2009, Karen Tochkov at the University at Albany conducted a social experiment on examining people's ability to accurately anticipate their emotions after a financial loss. For the experiment, she selected a group of 108 undergraduate psychology students from the university who responded that they liked to gamble in a survey that was provided earlier. 62 of the participants were female and the rest 46 were male students. This study happened in two phases. In the first phase, the university students were asked to imagine that they were making a gamble and asked them to rate how they would feel if they were to realize a loss in the process. For example, they were asked to consider how they would feel if they lost $150 during the gamble. So, they had to rate the extent to which they would feel disappointed after taking such a loss. A week later, in the second phase, the students were brought back to the laboratory for a follow-up visit. This time, however, instead of merely imagining they had made a losing gamble, they were actually made to gamble. The task involved 20 pairs of gambles displayed on a computer screen in a sequence, which was randomized separately for each student. Each gamble had two possible payoffs but with different probabilities. The probabilities were either 30% and 70% win rate or 10% and 90% win rate. Each pair of the gambles included one relatively safe option which had a small payoff with high probability and one risky gamble having a high payoff with low probability. This real-life gambling experiment made them feel the real consequences of losing money. The conclusions that were derived from the experimental study were that frequent gamblers or problem gamblers are someone who are addicted to gambling, and the results showed that these people misjudge their emotional experiences. They underestimated how disappointed they would feel after a loss, compared to the non-gamblers or social gamblers who are more realistic about losses. This ability to accurately anticipate how one feels after an actual gambling loss is associated with a concept called loss aversion. We humans hate losing. Whether it's a game or a possession or trading, we can't stand a loss. The larger the potential loss, the greater the pressure to prevent it in the first place. Loss aversion is that tendency of rejecting a gamble with an equal chance to win or lose for the same amount of money. It has to do with how we as humans relate to winning and losing. So our own human psychology makes it difficult to navigate the financial markets or the stock markets, which are filled with uncertainty and risk. And as a result, one of the most common mistakes traders make have to do with their poor risk management strategies. Most traders are often correct predicting the direction of the market, but where the problem lies is in how much profit is made when they are right versus how much they lose when they are wrong. As a bottom line, most often traders tend to make less on winning trades than what they lose on losing trades. So this phenomenon can be explained in such a way that the emotional impact of losses is far greater than that of the equivalent amount of gains. Nobel Prize winner Daniel Kahneman and Amos Tversky published a seminal paper in behavioral economics which showed that humans most often made irrational decisions when faced with potential gains and losses. The core concept associated with this study was simple yet profound. So most people make economic decisions not on the expected utility but on their attitudes towards winning and losing. So this can be simply understood that a rational person would make decisions purely on maximizing his gains and cutting down or minimizing his losses. And yet, this is not the case in the real world, and especially with the traders. Let's understand this idea using a graph from the study. In a real-life scenario, the negative feeling experienced from a 1,000 rupees loss can be substantially more than the positive feeling experienced from a 1,000 rupees gain. This is very clear from the difference in the y-axis values for pain and pleasure for the same amount of loss or gain as indicated in the utility curve. But what is more interesting is the fact that when you experience both these feelings at the same time, meaning you gained 1,000 rupees and then you lose that 1,000 rupees, it would leave you feeling the most worse or regretful, despite having no monetary loss accounted for in the process. So in practice, we need to find a way to straighten that utility curve so as to treat equivalent gains and losses as offsetting and thereby becoming a purely rational decision maker. This is far easier said than done. The sole idea of avoiding regret most often compels many traders to make poor investment decisions. For example, to avoid painful feelings of regret, traders hold on to losing positions, hoping that these positions will turn around, or they will do something like exiting a winning position prematurely to lock into quick gains. So this interplay between emotions and risk-taking keeps many traders second-guessing their decisions. So the challenge of trading is to accurately perceive risk, control your emotions, and execute a trade calmly and rationally. Overconfident traders, however, might have an inability to accurately gauge their emotions. The overconfident traders are most likely to think that it won't be so bad when they lose. This means that if you don't anticipate feeling badly after a loss, you'll have no problem taking a risky trade. So if you are making too many such risky trades in the process and you are paying a price for it, then one way to save yourself is to try focusing on how it feels to lose. Perhaps you're not thinking of the potential negative consequences of loss. However, if you focus on how badly you will feel after a loss, you'll stop taking needless risk and think through your trading decisions. And therefore, you'll be more likely to manage risk and you will wait for high probability trade setups rather than impulsively making a bad trade. There are some ways in which you can systematically avoid your emotions while trading in the market. Your primary goal should be to find trades that give you an edge and present an unsymmetrical risk profile. This means your primary objective is to achieve a robust reward to risk ratio, which is simply the ratio of how much you have at reward if the trade goes right versus how much you lose if you go wrong. Let's say a trader making money on only roughly 50% of his or her trades need to aim for a higher unit of reward to risk, let's say 1.5:1 or even 2:1 or greater. But too many traders get hung up on trying to achieve a higher win percentage, which is quite understandable when you think about the research we looked at earlier regarding loss aversion. But from a logical standpoint, it isn't realistic to expect to be right all the time. Losing is just a part of the process, and this is a fact that as a trader you must get comfortable with. It is more realistic and beneficial to achieve just a 45% win rate but with a 2:1 reward to risk ratio than it is to be right on 65% of your trade but with only a 1:2 reward to risk profile. Let's take an example to prove this. Consider two traders taking 20 trades each. Let us avoid the effects of transaction cost and slippages for this case. The first trader has an accuracy of only 45% but maintains a reward to risk of 2:1, while the second trader has a higher win percentage of 65% but the risk to reward is only 1:2. Over the course of 20 trade samples for each case, you can see clearly how a favorable reward to risk profile coupled with more losers than winners can be more productive than an unfavorable reward to risk profile coupled with a much greater number of winners. The trader making money on only 45% of the trades but with a 2:1 reward to risk profile comes out ahead, while the trader with 65% win rates makes only half as much on winners compared to the losers and comes out at a slightly net loss. I hope the point is clear. Now, once you have a trading plan that uses a proper reward to risk ratio, the next challenge is to stick to the plan. Remember the fact that it is natural for humans to want to hold on to losses and take profits early, but it makes for bad trading and eventual destruction. So we must at every cost overcome this natural tendency and remove our emotions from trading. So a great way to do this is to set up your trade with a stop loss and entry limit order from the beginning itself. But don't just set them for the sake of setting them or to achieve a specific ratio of reward to risk. You will still have to use your analysis to determine where the most logical prices are to place your stop loss and entry limit orders. Many traders use technical analysis and price action, which allows them to identify points on chart that may invalidate their setup, meaning the analysis has gone wrong and thereby trigger the stop loss. Or it may even validate your trade, meaning that it will trigger the entry limit order. Determining your exit positions or targets ahead of time will also ensure you to pursue the proper reward to risk ratio, most likely 1.5:1 or higher from the outset. And the most important thing, once you set them, do not touch them or change them at any cost. So once you make this process a habit, then only you can think about trailing your stop loss to break even when the trade goes in your favor. Managing your risk in this way is part of what many traders call the money management. I hope things are getting clearer, but this is just the beginning. We will continue this journey of mastering our emotions. So if you find this video useful, please do like the video and subscribe to the channel, and do not forget to press the bell icon to enable notifications so that you don't miss out on the upcoming videos. You can follow us on Instagram also. The link is in the description. I will see you guys in the next video. Till then, see you.